So our trading principle we're going to cover. First and foremost, what we're looking at today is we're looking at a double distribution. So I'm just going to draw that for you. In essence, in profiling terms, a double distribution is where a market has two very clearly defined areas of acceptance. Okay, the market is traded in two zones where it's accepted value quite easily, and in between we've left what is known as an LVA, or a low volume area, or an untraded area. Now, what ultimately causes the double distribution, and this is the real key, this is where the trading principle comes in, is that the market is positioned one way or the other. Something comes out that changes that position, and we get an unwind of that positioning, which is ultimately what leaves this low volume area, and then the market settles in a different area, or begins to accept value in a different area, thus leaving two distinct double distributions. And that's the real key. That's what I'm going to show you in a minute. So that is our understanding of a double distribution. Now, the important thing to understand is what creates this low volume area, because that presents not just the opportunity on the day of the double distribution, but also the day after the double distribution. Okay, now to understand intraday positioning, you've got to understand things like value area. Okay, we can see in yesterday's example, for almost the entire morning session, the cable or the pound sterling against the dollar spent the entire day outside of the previous day's range, and it accepted value there, from pretty much the overnight open at 11 p.m. All the way until the midday. Okay, we then got a little bit of fundamental news. Again, that probably was what created, the move to the downside. And ultimately, because of the positioning of the market, we got this very aggressive initiative to the downside. Once the market then found support, it then began the process of filling out a lower distribution. So that's kind of the context of what happened yesterday. So we have two defined value areas, one at the lower end and one at the higher end. Now, in order to understand how you take advantage of this with the profile or with the footprint, is you need to understand what a line in the sand is. Okay. Now, a line in the sand is nothing more than that point where the intraday positions, okay, that's locals, short-term time frames, algorithms. When the intraday positioning, okay, gets unwound, that is the line in the sand. Okay, it's that point where we see an unwind of those positions, that the market has effectively created. Now, the important thing to understand is that if I show you this in a minute, in fact, let's get this up so I can show it to you. And what we're going to look at is effectively the pound. Okay, so this is the pound sterling yesterday. We can see that yesterday's high was 133.30, and the market spent the entire morning outside of the previous day's range. Okay, now when a market spends a day, the session outside of a previous day's range, there's natural positioning. Okay, so there were natural longs in the market that had held on all the way until that B print, which is roughly 2:30 in the afternoon. Okay, now the line in the sand is simply that point where all the longs are likely to liquidate. Okay, now in yesterday's example, there was a very simple line in the sand to identify, and that was pretty much not just the cash low. Okay, we can see that M print, that was the cash low at 133.30, but also the previous day's high. So that 133.30 was almost a confluence level where it was the previous day's high, but it was also the 8 o'clock European Open low. So that 133.30 was our line in the sand. We're going to take a close look at that on the footprint and see how we could have taken advantage of this 100-tick move to the downside. Okay, so obviously, let me just quickly show you that is the double distribution. We get our first distribution in the morning, our low volume area, and our second distribution in the afternoon. Okay, now let's get back onto the slides and let's wrap up this principle. Okay, so what we're looking for on that position unwind is we're looking for initiative. Okay, why do we need initiative? Well, stops by the very nature are momentum driven, so they have to be quick, they have to be aggressive, which means we have to be aggressive in execution. Okay, now let's get onto the actual footprint and look how we could have executed this and taken advantage of it. Okay, so the first thing to do, I'm just going to quickly get up a footprint chart for you. Okay, so what we're looking at here is the footprint from yesterday. Now, what I've highlighted is effectively the beginning of the unwind. Okay, so this is where the comments came out, right? There was a little bit of commentary around Boris Johnson resigning, a little bit of news, and all of a sudden the market sold off. Okay, so we sold off from 90s all the way down to 50s. Quick 40-tick move. Right, now note each one of these is a 5-minute rotation. So the market then began the process of bouncing. Okay, there was a lot of two-way trade, and the market began to accept trading above that 133.53. Okay, we then had a second leg lower. Now, what is interesting on the second leg is we can already see imbalances beginning to form. Okay, we can see a nice 13 by 100, 0 by 68, 23 by 80, 23 by 115. So this is our first little key imbalance. Now, I'm not going to go over imbalances today. It is dealt with quite extensively in the footprint course. But in essence, that imbalance is telling us there's actually quite a lot of strong selling coming into the market. Okay. So the market then comes, and note where it bounces the first time. Okay, it bounces right in ahead of that key level line in the sand, 133.31. Okay, the market bounces there the first time, and we go all the way back up to 56. It's almost a good 20-tick bounce. All right, now note what happens on that bounce, and this is the real key takeaway. Note what we see from 48s up to 53s. Okay, almost 2,500, 3,000 contracts absorbed there. Okay, and that's the real key, was the market tested that support, bounced, okay, got absorbed quite aggressively by the sellers. They had a secondary go. Again, they defended the 133.30, bounced a second time up to 48s, and third time they actually broke through that line in the sand. Now, what is key? Note again, just before that break, note the imbalance from 35s to 40s, and then the real aggressive move all the way down to 30s. Okay, so that was our breakthrough. That was our breakout. Once we took out that line in the sand, we really got a punchy 10,000 contracts traded. That really confirms to us, the highest, pretty much the highest volume 5-minute rotation of the day. Also, nice negative delta. That's telling us there really was some very aggressive selling once we took out that line in the sand. Now, in terms of the execution, I'll go through this very briefly. There's two places we execute this. Okay, one, we do pre-position this, and I do teach this in the course. When there is a line in the sand, there is good risk reward in preempting. Okay, there's good risk reward in pre-positioning and adding ahead of the break. Why? Because we're looking for that aggressive, extension. So there's a lot of extra reward we can take, and it's not going to cost us too much extra risk. Okay, so the first thing is, once we saw this effective absorption here, we know where we want to stop at. We don't really want to see the market trading above 57s. Right, so once we had sort of had that second test and bounced a third time, we could see the market really just stopped at those 49s, anywhere in between sort of 45s up to sort of 55s would have been a very good preemptive short with a stop sitting at 57s. Okay, so not even 10 pips of stop, and we're looking for not just a test of 31s but also a break of the 31. So again, a good 40-50 tick winner, and it's only going to cost you roughly 5 to 10 ticks of stop. Okay, we then want to add. We want to add through the break. If we are filled, we want to add through the break. If we're not, we want to look to play for that break and extension. And if you miss that break and extension, then the third opportunity is that first little pullback. And again, note the absorption here from 20s all the way up to 22s. Again, we see those sellers absorbing, and again the cable has another little plunge down to 132.80. Okay, so that's our key takeaway, guys. It's that unwind. It's that 133.31. Now, where I want to touch upon is the profile strategy of double distribution. So what do we do now? Well, what's the play going forward for today? Now, traditionally, typically, this is the key rule of thumb. This is taught in the profiling course as well. When you have a double distribution, there is a high probability the market is going to fill out that low volume area. Okay? Key to note, one of the things that's taught, a double distribution shows us a pickup in volatility. Okay, now volatility tends to precede more volatility. Alright, so don't be surprised to see us have an inside day today in the sterling, unless obviously something fundamentally changes the landscape. But don't be surprised to see this market have a very firm inside day, I'd say almost even potential for an inside value area. So firmly inside 132.30 up to 133.60. Okay, and don't be surprised to see the market, really just spend the day rotating inside the middle of these two sort of, peaks of volume and TPO that were traded yesterday. Okay, so what we're looking for, and this is the real key, what we're looking for is we're looking for the market to try and show volatility to the upside into which we fade. Okay, note what I just said. We expect there to be some volatility. Why? Because of the wide range from yesterday. So what we're looking at is if the market is volatile to the upside, technically, okay, not new news or anything, if it's volatile to the upside and we see sellers begin to absorb the market, right, those buyers are very quickly going to back out of being too aggressive. Okay, that's the real key to a double distribution. You don't want to be buying it up here equally. You don't want to be selling it down here. Okay, you ultimately want to let the market exhaust itself, be aggressive to the upside, sell into it, let it be aggressive to the downside, and buy into it. That's the real key to trading the double distribution day. Okay, what I will say, I'm just going to bring that footprint in one more time. There's a sneaky little clue. Don't forget, we spoke about this line in the sand yesterday, 133.31. Don't be afraid to try and look for absorption around that 33.31. Should act as a very good resistance area first time. And if that fails, 48 to 53s, okay, that's where the sellers really stepped in very aggressively yesterday. Wouldn't be surprised to see 48 to 53s act as a potential high of the day.